I think also, if one is over leveraged or a market becomes over leveraged, there's there's great danger that what will happen and is that doors can be shut on trading, and liquidity becomes constrained. Now, that in terms of what Dukia is doing in the gold market, there is not. There's no constraint in terms of being able to buy or sell. It's not a leveraged position, and in fact it's 100% backed by physical gold. So there is no credit risk either, and of course delivery can be taken, which it can that can have difficulties in terms of timing, costs, and that sort of thing. But it's not a major area for concern. So really, those are just my thoughts on what's been going on in recent times, and I'm sure Mr. Pakbemi will also have some thoughts and considerations to bring to you as well. But thanks for being here today, and I hope that you find some value in what we have been talking about and what we will be talking about for the rest of this seminar. Thank you all.
Thank you very much, Paul, once again for first reminding us that global warming is real, and it will be to everyone's peril to ignore global warming. The implication for that is not every house that's built near the coast or coastal cities go unscathed. There is bound to be loss of value of some prime real estate, not just for flood, but also for fire and fire incident. One metal that does not destroy itself in a fire outbreak is gold. One metal that does also sink, wash away easily when there is a flood is gold. Again, we remind you, balance your portfolio, put some assets in gold. We've also had Paul talk very carefully about gold price being fairly well bounded now in terms of its behavior. Again, gold is a very cautious metal. It's a very cautious investment. What it's doing that is hedging every risk, and it's all priced into it right now, waiting for, God forbid, a bubble. But certainly the signs are again very imminent. But we believe that even though the signs are imminent, gold is bound to perform in a manner that it has always done, maybe over the last 100, 200 years, or more particularly, at least in the last 25 to 40 years. So we're very certain that gold is reasonably priced now for anyone who needs to get into a safe harbor, basically prepare wealth and preserve wealth for himself and for the next generation yet unborn. Gold is not necessarily a short-term investment, it's a long-term investment. And the reason why you need gold as a long-term investment will be again explained to you in detail during this meeting. So I would like to say I'm grateful, very, very grateful for the opportunity always to be with you. I'll yield the microphone to Emmanuel so we can get on. Emmanuel,
okay, thank you very much, sir. And thank you, Mr. Paul Beasley, for those opening comments. We'll begin the presentation as swift as possible. Now, the nature of this presentation is on gold as a safe haven in an unstable financial system. Um, the financial system cuts across both those in Nigeria and those across Nigeria, from living in Nigeria, navigating interest rates, handling inflation, and other perspectives. So what are we going to discuss about today? First and foremost, you should know that this presentation is going to contain forward-looking statements, and as such, we'll plead that you seek the advice of a financial advisor before you make an investment decision. But be rest assured that this presentation is contained by accurate facts and figures that is going to help you make better investment decisions as you proceed. Now, Dukia Gold is being led by a dynamic and highly experienced team of professionals. You just heard from the chairman and chief operating officer. The managing director will still be on board to actually give us the welcome address. But the emphasis of our presentation is to discuss about the global monetary reset and how gold is used as a portfolio protection tool rather than a short-term speculative asset. Why you need to be very, very cautious while you're investing in gold, and not investing in gold as to buy and sell in the next 1 week or 1 day or the next 3 hours. You need to see it as a portfolio protection over the course of your time. Now we are going to discuss central banks, China, and global gold demand, and why these two countries, mostly China and India, are beginning to actually now influence the way the gold market is running rapidly. Then we are going to discuss physical gold, paper gold, and gold-backed tokens, and the differences between these three asset classes in case, and how you can understand the case for investment in the equity of gold-producing entities. Then they are going to give you brief descriptions on opportunities for you to actually make the investment decision, choosing the right exposure, and giving you perspective of how you can move forward. Then we'll conclude and we'll do a Q&A. But to begin the presentation in earnest, I will invite the managing director, Madam Bosse Olabi, to actually lead us through the presentation. Mbima, you have the floor.
Good afternoon, everyone. It's my pleasure to welcome us once again to our monthly seminar. And this month's seminar is titled Gold as a Safe Haven in an Unstable Financial System. And we all understand why this is a topic that is very important at this time, given the instability that we have everywhere. There's volatility in different countries or different parts of the world. And what has been a constant in all this, it's gold. It's been the ultimate anchor, and it has a proven longevity. And it's shown that even when there's chaos everywhere, gold thrives. So today, we will take you through the opportunities, because in every time there's a problem, it will there are risks involved, but at the same time there are opportunities that we can all take advantage of. And Emmanuel will take us today through those key points, what is happening, especially how Asia is also driving a lot of demand and influencing the pricing in the gold market. These are all things that are happening that we all need to be aware of, and which will guide our investment. At Dukia Gold, we pride ourselves as a leader in this industry, and as much as possible, we want to keep encouraging people to key into gold investments. And we know that this will help all of us defend and grow our hard-earned income, and to provide and save towards our future. So whatever we find that is key and important to your wealth management, be sure that we will bring it up for you to know. As Emmanuel said, we are not your wealth managers directly, so you still have that duty to speak to your financial advisors before you take your decisions. But we bring to you real and factual things that are happening all over the world that we think are beneficial for you. Thank you, everyone. I would hand over to Emmanuel, who will take us through what will be a very insightful session once again. Thank you, everyone. And the question and answers will follow as usual after the presentation by Emmanuel and some discussions by the chairman. And then we will take your questions in the chat box. Thank you, everyone, and enjoy the session. Emmanuel, over to you.
Welcome address. And swiftly, we're going to begin the emphasis of the presentation. Okay, the topic is the global monetary reset. Now, what is that term called? Now, it's not a big term used by the International Monetary Fund or the World Bank or the Bank of International Settlements. It is a term used by financial experts all across the world, showing that there is now a restructuring of how money works around the world. Most especially, central banks have now begun to hold more gold as part of their reserves. Also, most countries are now reducing their dependence on dollar denominated assets. Moreover, there is now an increased use of local currencies in trade. There's a development of very new payment and settlement networks. Most countries have seen the rigor it takes to operate the SWIFT, and they have now begun to develop new and better settlement networks to actually advance trade. And there's a greater use of tangible strategic assets and a movement towards a more multiple. The emphasis of these points I mentioned here, where central banks and other currencies are reducing their dependence on dollar denominated assets and increasing their reserves, most especially in gold. You understand the fundamental concepts in this presentation. Also, in essence, how does that relate to gold? We all know that gold is a unique asset class because it's not the liability of any government or bank or company. There's a term that we normally say in most of our presentations that gold has no counterparty risks. Now, for a government bond, the counterparty risk of a bond is that it's a promise by a government to pay. Like when you're purchasing the naira bonds or the dollar bonds or whatever fiat currency bonds you have, it's a promise by a government to actually pay that return with interest. For a bank deposit, it's a claim against the bank. You cannot deposit money in Access Bank and go to Zenith Bank to withdraw it, or vice versa. For a company share, it requires ownership in a business because if you buy the shares on any of the exchanges made available to you, you are now claiming ownership in that particular entity that you value what they are doing and they are going to benefit from what they have managed across the year. But for physical gold has no counterparty risks in the sense that it does not require another party to perform before it has value. As we fondly say that a gram of gold, a kilogram of gold in Nigeria is the same kilogram of gold in UK, in Switzerland, in US, in Australia, all across the world. It does not need a central bank to validate its authority. It does not need a government to settle the payment. It does not need a business owner to make claims to it. It has no other need for counterparty risks. And because of this unique characteristics of gold as an investment asset, it is very, very attractive during periods of the debt concerns or geopolitical sanctions or a loss of confidence in financial institutions. As we always, as I said here, that gold is better understood as like a financial insurance. The same way you buy your life insurance or you get a car insurance or you buy an extinguisher for your car or you buy safety brakes for your vehicle, you are not expecting that vehicle to burn next month in the case of a fire extinguisher. You are buying it because the financial consequences will be severe if the event occurred. So in the case of gold, you're not buying gold because there's going to be huge, massive depression on your whole assets. But the consequences of that depression is going to now wipe out your entire savings. And why you are buying gold is to use it as a hedge against all these volatilities. Now, there are so many factors actually influencing the way gold works. And for you to actually now take notice of that, most especially the supply and demand. There's a finite amount of gold in the world. So any sudden change to the supply or demand would definitely impact its price. Annual mine production has about 2 to 3% above gold ground stock. So you now know that the supply of gold is between 2 to 3%. However, there's definitely increased demand, as noticed by the Chinese and Indian jewelry markets. We know that the forthcoming October is the wedding season for the whole of India, and definitely that aggressive demand by India to actually purchase gold for its jewelry demands will actually see it rise to an astronomical price. In recent years, for the beginning of January to June 2026, China and India's combined purchases were equivalent to 37.7% of global mine production, compared to 40.9% for the full year. But clearly, China's bar and gold demand was particularly strong at 314 tons, while India reached its demand at 113 tons. This shows that even though the purchases, and we are estimating for the beginning to the middle of the year of 2026, even though its purchases were 30.7%, the 7.7%, its bar and con demand was definitely enormous, as shown by the bar chart below. So we have definitely know that the supply and demand of gold will definitely play an increase to the price. As we all know in basic economics, that when the demand of a commodity exceeds the supply, the price is definitely going to increase, and which we are seeing now with these two countries. Clearly, there's also economic and political circumstances as it comes to gold. Where the economic situation is weak, most people will hold on to gold because it has intrinsic value, like its counterparty risks, that it has no counterparty risks, as I mentioned before, which is going to push up with demands and in price. So just as the price of gold peaks during time of inflation can tend to push it down as the fiat strengthens and investors regain confidence. That's why we saw the fluctuations of gold during February to April 2026, when the rumors of wars were evolving and there was so much uncertainty around these climates that affected that price of gold. Also, the most important factor you consider is the central banks buying and selling. The major central banks all across the world have been increasing their reserves of gold, especially with Poland and China driving the lead. If you notice, much of the central bank's buying activity was driven by Poland, which bought 18 tons during the first half of the year, and China, which bought 10 tons. You also see countries like Uzbekistan or Kazakhstan also increasing their monthly gold buying activity. You see also countries like Singapore rejoining the list of buyers, reporting a net purchase of 4 tons, its first monthly net purchase since September 2025. So all these countries from Poland, Uzbekistan, China, Czech Republic, Chile, and Singapore, even Jordan, have now begun to increase their reserves in gold for their countries. And as they are doing that for the countries, you should too. Because if the central bank, the major principal entity that directs economic and monetary activities for a country, is increasing its net reserves in gold, you ought to take the initiative and begin to increase your own net reserves in gold for yourself and for your families. Also, inflation and interest rates actually govern how the gold dynamic works. We notice that the Central Bank of Nigeria recently retained its monetary policy rate at the level it is now. But clearly, when the interest rates goes down, most people will now begin to assume speculatively that they are not going to get far more returns on their money than they would in gold, and which actually makes them to purchase gold as a reserve asset. So all these economic uncertainties like inflation, central bank buying demand, and supply and demand actually influence the way gold works in the marketplace. Now, for Asia, there are very particular things you want to take consideration of. You notice that China's demand has increased 70%, 7% year over year. But for Shanghai, with the Shanghai Gold Exchange, they have begun to involve themselves in physical delivery, including yuan-dominated contracts and international deliverables. For Kong, Hong Kong has begun a trial operation in a new central gold clearing and settlement system, which began on July 7th. So these countries, for Shanghai, like the Shanghai Gold Exchange, for Hong Kong, with its government policies, have begun to take initiatives not just to participate in increasing their reserves, but to actually influence how the gold market works across board. In essence, we are saying that for Asian influence, the Asian markets are becoming more important to physical demand, settlement, and price. Now, clearly, we are not discarding the London Bullion Market Exchange, which is located in London, or the COMEX, which is located in New York. But we have seen the Asian markets begin to drive with their huge demand for their reserves and their ability to navigate gold exchange contracts like the Shanghai Gold Exchange. We have seen them influence the way gold demand and pricing works across board. And most importantly, apart from that, there's a declining low of US treasuries. If you notice, at the end of December 2025, foreign investors held approximately 9.27 trillion of US Treasury securities. Now, if you are not conversant, US Treasury just means US debt. It's like the US comes to you and they say, borrow us money, we want to fund a war in Iran. And you give them money, you are purchasing a US Treasury. But in major countries like China and Japan, who hold approximately 30.2% of all US treasuries, they have begun to sell off those US treasuries, declining to about 20.2% in 2025, towards the end of 2025. So from this chart, we see that these countries, which were formerly domiciled their foreign reserves in US treasuries, in USD, have begun to sell off their massive US treasuries and begun to import more gold as part of their reserves assets. Now, what does this tell you? If the major countries, which are the major principal buyers of US debt and of USD, are beginning to sell off their US treasuries to purchase gold, it shows you that that the confidence in the USD as a reserve asset is now dwindling aggressively. Reserve managers are increasingly unwilling to depend on the USD as a store of value. But guess where they have switched to? We have seen their demand on gold, and we've seen the charts showing that most has they've begun to sell off their US treasuries. They have begun to purchase gold in actual measure. Now, we'll dive deeper into the role of central banks, China, and the global gold demand. From a chart, the World Gold Council estimated that the total gold demand exceeded 5,000 tons in 2025. The investment demand reached 2,175 tons. The bar and coin demand reached approximately 1,374 tons, while the central banks purchased approximately 863 tons of gold across the world. Clearly, we have often seen countries like the Philippines and Serbia and El Salvador begun to increase their gold reserves. Has in a statement from the president of the National Bank of Serbia, he was saying that he plans to boost his gold reserves to at least 100 tons by 2030. And the demand of gold is still a valid principle by central banks and by countries all around the world. So for institutional investors, you should be rest assured that the demand of gold is not going to go fast across the world. Even though there may be fluctuations in its price due to uncertainty levels and geopolitics, the demand of gold is a stable, factual proof, knowing you that the price of gold will definitely rebalance on the long run. Now, there's a shift from the west to the east, and how the east have begun to influence gold market prices. In 2025, we saw a surprising phenomenon where the Chinese bar and coin purchases exceeded jewelry consumption for the first time. Um, in previous presentations, we thought that the major reason why China and India were buying gold was for jewelry consumption. You know that Indian weddings are mostly in October, and most of them would love to wear all the blings across the world. But clearly, we are seeing a new concept governing their buying pattern. Like in 2025, Chinese were explicitly demanding for bar and coin purchases, that's investment grade gold, not as jewelry purchases, but for their own reserve assets. So they are increasingly demanding for physical gold in bars and coins, and for in technological products and by the central banks and other official institutions, more than they were depending on jewelry or watches or chains or necklaces or what have you. Also, the first quarter of 2026, we've noticed this same trend happening all over again. China accounted for roughly 44% of total global bar and coin demand in Q1 2026, roughly 44%. And by June 2026, the People's Bank of China just added another 40 tons during the first half, bringing its reserve to 2,346 tons. The June physical demand improved month over month, but clearly remained historically subdued across board. So this shift is telling us that why China, most especially, is beginning to buy gold in large quantities. They are not buying gold for jewelry main purposes. They are buying gold, most specifically investment grade gold, for its investment needs. Clearly, investment demand has shown more stronger than jewelry demand in the case of these countries. And I'll give you another perspective. Another perspective. Several major Chinese banks, including the Industrial and Commercial Bank of China, the Chinese Construction Bank, and the People's Bank of China, closed retail services that allowed people to exchange in precious metal contracts. Now, for those of you who are not aware, precious metals contracts allows individuals to be exposed to gold without having a claim to its physical assets. So you can now leverage on your assets to be exposed to the gold market, but you have no claim to its individual assets entirely. And major Chinese banks in 2026 says it's enough. We are not allowing people to do that and trade on the Shanghai Gold Exchange. Why were they asking people not to trade on these leverage gold products? They stated that it was okay, it's risk management and market volatility and investor protection. But that statement was consistent to all the previous buying patterns that we have seen. The first is that they have declined their US Treasury holdings. The second is that their central bank, the People's Bank of China, have begun to accumulate gold in extraordinary amounts. During the Q1 of 2026, they accounted for 44%. Clearly, we are seeing a continuous demand in gold, but not just any type of gold, for investment grade bars and coins. The bars and coins, not in the standard 350 to 430 ounces, not in the standard 12.5 kilogram bars, but the 1 gram, the 10 gram, the 1 kilogram, and all these other precious metals. Now, the fourth, they have now limited their use of leveraging products and futures and derivatives to actually get exposed to gold. So all these evidences put together is seeing why China has a influence, is beginning to seek greater control over its reserve and investment assets.
Manuel, your voice faded away. But while Emmanuel comes back online, I just want us to note some very important matters that he has brought up. First, there are increasing buyers of gold in the world market. The most important buyer today is China. Why? China certainly generates most of the products that is feeding the industry everywhere. So China is big. China is not just buying for a central bank position. China is now using every available major institution in China to acquire gold, including their pension fund, their Bank of Commerce, and their Bank for Communications. All of the five largest institutions in China are actually acquiring physical gold. That means a lot. If you know the story of Enbridge, you know the story of SWIFT, and you know the story of BRICS. It's also important that you note what India is also doing. India is saying, don't buy jewelry gold, but they did not say don't buy what they call physical gold as investment. If you visit Korea, that he has mentioned, Korea today is fully diversifying all of its assets away from so-called market to physical gold. That's clear because they are beginning to sneeze. Japan will catch gold eventually. And of course, the Middle East will continue to affect the fortunes of the world. I pray that the price of oil keeps up because of Nigeria, but the higher the price of oil is, the better it is in terms of income for Nigeria. But winter is coming. Not many homes in England, Europe, America, anywhere that actually turns cold at November to be able to afford these prices. So there is a major situation coming around the world. We've seen it before. They've tried all their best to limit the spike in prices, but certainly I'm not sure that Turkey can sell its gold again. The quantity they sold the last time was a bit large. Surely Russia recovered from the initial shocks that allowed them also to sell large quantities of gold. Therefore, the market is surely stable, and the safe haven direction of investment led by China is bound to continue. And he's also mentioned something. If you are looking at a spike in prices, watch out for the marriage season, both in India and in Nigeria. Those people who are coming back for 30 December and the rest of them are only coming to many big parties that require gold and gold consumption. While jewelry is still high, those who are investing other than jewelry are also coming to the final realization that gold is. Michael, sorry. Emmanuel, if you are back, just let me hear a hello and return your screen to PowerPoint presentation mode. Thank you. So basically, what is been saying is basically to underscore the fact that oil and gas remains elevated in terms of price. That has implications for the balance of payment of most countries, inflation, agri, and the rest of them. Paul mentioned global warming. It has material implications for commodities, daily of crops actually doing well and then being flooded in. The route through the Hormuz, through the Suez Canal, currently challenged. It also has very great implications for grain and movement of commodities within Europe and the rest of the world. The fight between Ukraine and Russia will continue. And if it does continue, we've already seen the initial spike in the prices of grains and fertilizers and stuff. If it doesn't abate, surely Ukraine cannot contribute to the world export for wheat, and everybody needs to worry themselves. But the story that Emmanuel is pushing is the true story of Enbridge versus the SWIFT and the active participation of what you call the BRICS. We would see it as a direct fight between which currency or pseudo currency will reign supreme. Don't forget, even the so-called IMF and, of course, the World Bank itself, as under the Basel III, agreed that there are 4 types of currencies. There's a local currency of the country, which is a fiat currency, is an IOU. There is an international currency, a basket of it, led by the dollar. Yen has forced itself onto the plate. Euro has been there for a while, and pound sterling has always been a traditional one. But of course, the most dominant, because of the fact that most crude oil prices are stated in oil and gas for dollar, and also commodities are largely priced in dollar. So dollar is very dominant. But what they have cleverly approved is the gold as a mode and means of settlement. To the extent that gold has joined this liquidity ranking, everyone is basically devolving away from fiat currency or anything by way of investment that is bound or tied to a state government or perhaps to the liquidity of an institution. Everybody is switching into physical gold. And the story that Emmanuel was just telling in China is that Chinese government is encouraging everyone to move into physical gold. And the reason why they want you and I to move into physical gold is that it's best for long-term ownership, even though you may have what you call a high cost of entry. if you hold that as an asset, it's definitely held outside the United States financial system. So if there's any kind of expropriation, of course, it won't affect your country. And if China truly brings all the gold back home, what it will mean is that they would have perhaps for the first time more gold in China than they currently have in Europe, or perhaps more gold in China than they currently have in the United States. As you know, there's a lot of doubt about the quantity of gold currently in the United States. Many people are asking for an audit. When that happens, we would know. But what is important to note is that surely everyone from Korea to India to Japan to China, all in the Middle East, are acquiring more and more gold, and everything is going in that direction. So I will yield the microphone again to Emmanuel if he's back, but if he's not, I think we can switch screen. I'll continue with the presentation, and when he comes back online, we can take it. MD, please confirm if Emmanuel is here. I mean, just to before I okay. Can you hear me, please, everyone?
He is not back.
Okay, fine. So, Tonia, please switch your screen, and then I can continue the presentation on it. Go to PowerPoint presentation, please. Anyway, my apologies. Technology works, and sometimes it also does create trouble. We were on the page where he had shown you who is buying and who is selling, and he's also giving you the many reasons for why you need to buy gold. The Chinese banks, including the ICBC, the China Construction Bank, the Postal Savings Bank, surely are the largest financial institutions in China, and they do rank amongst the top 10 in the world. They have also been very instrumental in acquiring a lot of gold. The effect of all of this is basically to ensure that the quantum of gold within the so-called banking system within China and the ability to be able to settle carry trades in currencies other than dollar is becoming increasingly nice. They are also encouraging African economies, especially Nigeria, South Africa, Zimbabwe, Zambia, Egypt, including even the African Export-Import Bank, to ensure that more gold is kept by central banks. Ghana is the most recent example, and they did make a lot of profit from their transactions sometime in November, December last year. They've normalized, and they're again building up again this year. So we know that whatever we are talking about, the changes are consistent. The Chinese, yes, make a preference, but certainly whether they are number one economy or number two economy, every one of us needs to take note and, of course, understand that whatever it is that they are doing will make sense eventually to all of us. So trust me, just be like a good central banker, buy some gold. So just to tap this page up, is that China is reducing its retail exposure to any kind of leverage gold. They're actually taking on physical gold so that even if the so-called ETF and paper and fiat money backed gold goes away in China or in Europe and or America, they don't leave you exposed because basically they have physical delivery of the product. Next slide, please. Basically, soon taking care of that. Next slide, please. Because they've taken care of all of that back home, it's easy to go ahead and discuss the the next slide.
Okay, I sincerely apologize, everyone, for that. Yeah, I was talking, but I didn't know I was not audible. So I'll just reshare my screen and start afresh. Sorry about that.
Welcome back, Emmanuel. I apologize, but in your absence, we just dwelt on your Chinese conversion of paper gold into physical gold. So I'll yield the microphone to you. Thank you.
Thank you very much. All right. Okay, this was the actual picture showing how the recent post from the Industrial and Commercial Bank of China showing how they stopped or they've decreased their use of people using futures and derivatives to actually buy gold. In essence, China has been giving you perspectives of how you can actually operate in the gold market. And they've institutionally said that we don't want people to begin trading in futures derivatives. Now, I'm not discrediting the Shanghai Gold Exchange because the rules of there still allow people to use derivative contracts to actually operate in the gold market. But for institutional investors like the Industrial and Commercial Bank of China, which their post is on your screen, the People's Bank of China, the pension funds in China, they've actually decreased their use of leveraged gold products for investors to actually participate. Why is China now having to purchase a lot of gold as an investor? Clearly, there's limitations on their credit wordings. For Chinese savers, they have a very limited investment options. They don't, their property and stock markets are a bit volatile and uncertain. So for them, they have begun to use gold as a safe and liquid store of value. Small bars of gold, small coins, and other savings plans have made it easier for them to actually buy investment grade gold without any hassle. Now, I've repeated this point over and over again that there's a major shift from jewelry to bullion. In 2025, we've noticed that the bar and coin purchases of gold exceeded the jewelry purchases of gold for the first time in the whole of the world. And that has actually increased during the first half of 2026. So gold jewelry naturally serves as decoration and service, but we notice as with all forms of jewelry, it includes retail markups, it includes taxes, it includes labor costs, it includes minting costs, it includes customization costs. Everything that your jewelry will need to have has it. And all these costs are making it far more expensive for Chinese savers to actually invest in gold. And they've turned to bars and coins as a cheaper and more favorable options. Clearly, there's favorable tax investment in investment grade bullion than in jewelry. So investment grade gold will receive a favorable tax treatment than jewelry forms of gold. Also, the strong infrastructure allowing people to begin to invest in gold. There's Shanghai Gold Exchange, there's commercial gold products. And most importantly, dwell on this, there's a gold savings plan. So even if you don't have the money to buy 1 kilogram, there are savings plans and automated options for Chinese savers to begin to invest in gold incrementally. Next, there's the central bank buying. We've made it official that the People's Bank of China has continued to increase its gold reserves. The official purchase from the People's Bank of China beginning to increase its gold reserves has created a net effect on the whole of the Chinese entirety. Because if they are seeing that their central banks are doing the same thing, the people are naturally now inclined to begin to buy investment grade gold and using gold savings plans to actually hedge their portfolio. And most importantly, there's a geographical stickiness when it comes for you to export investment grade gold out of China. There's so many barriers, so many policy restrictions. You can import all the gold you want into China, but getting one piece of that pie out, it is going to take far more bureaucracy and policy restrictions than you think. So gold is entering China more easily than it leaves China. And all these factors, from the central bank buying to the geographical stickiness, to the gold infrastructures, to the gold savings plans, are making sure that people in China are beginning to increase their gold reserves. Spot Gold Trading Center in London. I'm not discounting the COMEX trading fluctuations in New York. I'm not discounting their effects, but clearly, I'm only saying from data, proving data, that Asian influence in trading is increasing throughout the gold market. The price discovery is becoming more geographically distributed. Chinese demand is clearly influencing the price at which Western markets must clear. And we've seen this throughout 2025. We've seen this in the first half of 2026, and we are bound to see it throughout the end of the year. And one thing is certain: if the demand definitely exceeds the supply, the price is going to go up. While gold dropped to $3,900, and I got a myriad of calls and texts and messages that what's happening to my investment portfolio. And the way I answer them is to show them the facts, not to show them an emotion. Show them the fact that clearly there may be a fluctuation in price, but the demand is still going to be there all through the time. The demand of gold is going to definitely exceed the supply. We can't increase the supply unless new technologies increase the average gold production to maybe 5%, because currently we know it's between 2 and 3%. But that demand is still going to be as fundamental as the gold industry. And for you as a person, the supply and the price is definitely going to increase. So what does this mean? That we have noticed China's emergence in the world's gold consumer and producer. We have noticed India and China, these two countries, accounting for more than half of the global retail bullion. We have noticed that most people now prefer the kilogram and smaller bars. You know that in the LBMA, they actually trade using wholesale bars, the standard 400-ounce gold bars or the 12.5 kilograms. But clearly, for Chinese savers, for Indian savers, for those in the Asian countries, they're actually preferring those bars to be minted and into smaller kilogram and smaller gram bars and shipped to their locations where they can begin to invest using gold savings plans. They have noticed continued gold purchase by the People's Bank of China, and we have seen the development of the Shanghai Gold Exchange and the Shanghai Gold Benchmark. And institutionally, we've seen them creating opportunities, the infrastructure, the policy, the mass market ecosystem for them to begin to keep gold have moved eastward. So that's the essence of our presentation, the shift from west to east. While benchmark pricing begins in London, while futures and leverage trading begins in New York, the consumer demand, the physical ownership, which we are all beginning to key in, have begun to move to East Asia. Now, we are going to talk about physical gold, paper gold, and gold tokens, and how we coins and the allocated gold bars. The owner processes the metal directly and has legal title to the specifically identified bars. So as an owner, you possess the metal directly. You don't have a credit balance against the bank. That's why I find it very amusing when people say, I'm going to just send Dukia gold money and leave it there. We cannot keep cash. We are only licensed to keep gold. So I immediately want be automatically converted to gold within a short period of time. So I have to beckon on them to begin to buy gold using the cash they've deposited in a bank, most people will feel, okay, I've sent the money to the account. Why don't you just buy it from me? And I'm not licensed to do that. In the case of physical gold, the investor or entity is backed by a specifically identified metal. This means that physical gold has no corporate earnings risks. It's not another institution's payment obligation. It's in gold in its entirety. Also, there is the case of paper gold. Paper gold is a broad term for financial instruments that provide the exposure to the price of gold without requiring the investor to personally store bullion. Yeah, in the case of the futures contracts, the derivatives, where people can have ownership to gold and the doesn't require the investor to personally store gold bullion. Like in the case of COMEX in New York, a standard COMEX contract is 100 troy ounces. This is approximately $406,000. This means that just a 1% change in that price. Now imagine if it was 10%, you're either going to lose $40,000 or gain $40,000. That volatility is well packed into paper gold. And that's why I'm not surprised that the Industrial and Commercial Bank of China was seizing for its savers to actually come off of their gold holdings because of the volatility. And most importantly, you do not have a claim to that gold. Now, they offer convenient trading. They have lower personal storage costs. They have the convenience of you just participating in the gold market, but the losses can be exceptionally magnified more than the cash you've deposited. And that's why we gold investors. Now, we are not liable for investment decisions, but we are giving you the proof that if institutions are restricting people from actually participating in form of paper gold, you should too. Now, there's another entity called gold exchange trading funds, whereby it can be backed primarily or entirely by vaulted bullion. Now, as an ETF investor, you are going to own shares in a trust. But clearly, having shares in a trust does not mean you have personal possession of the identified bar. You have to just take the share in the trust. And clearly, retail investors may be unable to redeem the ordinary quantity of shares for that physical gold. Even if you want to say, okay, my quantity of shares I want to be converted to automatic gold, it may not actually work in the case. Now, there's a gold ETF that's in my head, but I don't want to mention the name, whereby their liquidity volume is 1/5. So it is so hard, even if you purchase that ETF, it is so hard for you to actually sell and regain your money back because the liquidity is not as much as it should be. Now, there are direct risks of using paper gold on investors. Party risks, it is still enormous like fiat currencies because the bank, the broker, the issuer may fail to meet its obligations. And it doesn't give you a direct ownership or a financial claim or a specific claim to the gold bars itself. Also, it comes with expiry or rollover risks that futures contracts must be renewed, and it requires issuer risks. That means the certificates for the issuer may lose value if the institution becomes insolvent. And the leverage risks and also the redemption risks are not quite what an investor should actually operate in. But there's another form of gold that actually combines convenience and the claim of a physical deliverable bar. That's gold-backed tokens. A properly structured gold-backed token represents a defined quantity of physical bullion held in professional will receive ownership rights or a contractual claim over the allocated gold. So gold-backed tokens are combining that convenience and that exposure to the gold market together with the claim of a physical ownership, giving where their gold token represents 1 troy ounce of gold held in MBO bonds. They are seeing institutions like Tether Gold, whereby their own Tether token represents 1 fine troy ounce of gold in the LBNA standardized physical bar. So for gold-backed tokens, it's giving you a middle ground whereby you are giving the exposure to the gold markets and they are giving identifiable physical deliverable bars and coins. And for us at Dukia Gold, we are not actually relaxing our odds. Both the benefits of the physical claim of delivery with an additionally convenience that enables you to transact in the gold markets from the comfort of your homes. We've already done this using the Dukia Gold app. Using the Dukia Gold app, you can actually make your purchases of gold and begin to hedge your portfolio and diversify your investment decisions. But we are giving a far more flexible option with the gold-backed token, which is still in development, giving you the best and an innovative combination. In essence, what do you do as an investment decision? Okay, gold is definitely useful. There's going to be excessive government debt. We definitely know there's going to be currency depreciation. I just was listening to yesterday as the farm major startup in food groceries just shut down because of the volatility in there's definitely going to be need for geopolitical uncertainty. So clearly, for you as an investor, gold is the best platform. Physically deliverable gold, not jewelry and not paper gold, is going to give you the strength to actually dive. Diversify and hedge your portfolio into. The central question is not whether gold will increase tomorrow. It's not whether gold will fluctuate next year. It's not whether the price of gold is stable or unstable. Clearly, the question is what quantity of gold will you need to purchase to increase your financial position over the course of time? That's the central piece of this pie. Not, okay, gold price is rising, gold price is falling, which we should definitely do. But we've understood from this presentation that demand is definitely going to be exceeding the supply. We've seen a huge chunk of demand in East Asia, and we've seen a huge chunk of demand from other institutional investors. I'm just using East Asia as a point of reference because they have been aggressively, for want of word, buying gold to stop its reserves. We've seen institutions limit the excessive use to futures and leverage trading. And for you as an investor, you begin to consider all these investment decisions and all these geopolitics happening around the world and begin to take that good step to actually diversify your portfolio. And the best way to do that is using Dukia Gold platform. As an entity, we pride ourselves as the West Africa's foremost full-service bullion merchant and Nigeria's pioneer in full-service bullion solutions. We are giving you the perspective to own every piece of the precious metal supply chain, from the exploration to the mining and the depository, where you can actually take ownership of your gold bars. And most importantly, for want of reiterating it, we need to say that any gold you purchase with Dukia Gold is not a leveraged margin. It's a physical claim to a physical gold bar. Clearly, that is the most important point. We are giving you, as an investor, the opportunity to participate in a gold ownership by taking claim to a physical gold if you purchase through and via our platforms. We've been featured in various newspapers and organizations around the world, and we pride ourselves on the issue of compliance. In actually following, if you notice throughout the presentations, I was definitely referring to these institutions like the LBMA and the World Gold Council and the OECD regulations in defining how physical gold, paper gold, and gold-backed tokens work in the ecosystems. And this is in line with our compliance policy, making sure that we complement all other standards, making sure that for investors, you have your investment decisions secured and carefully safeguarded with our gold-backed portfolio. Clearly, we give you real-time pricing. We give you dollar cost averaging, an option whereby you can flexibly purchase investment-grade gold from the comfort of your homes, and they are regulated and trusted by entities all across the world. The basic step you need to do is to register on the website or download the mobile app for convenience, complete your profile, verify your KYC, and fund your account. And that will give you the best in class of using gold as an investment portfolio for yourself and for your family. Thank you very, very, very much for sticking with me throughout this presentation and throughout the network issues. And we'll take your Q&A. Thank you, everyone.
Welcome back, Emmanuel. Thank you for the presentation. Very well. A lot of very hard facts have been presented by you, and those facts certainly is not lost on anyone. In very basic summary, what you have shown once again is there is a demand for gold and there is a supply of gold. Total amount of gold out of the ground currently supplied by many countries, including Nigeria, Canada, everywhere, processed through the best of all refineries, whether it's Switzerland or in London or America or wherever, including Nigeria, does not meet demand. So the situation is clear. Supply cannot catch up with the demand at this present. The second thing that you have said is that, yes, traditionally, central banks used to be owners of gold. And once upon a time, the dollar itself was tied to gold. It was linked sometime in the 70s. And since then, quote unquote, the amount of gold in the United States vault is known. And hopefully the amount at which they keep it on their balance sheet is also known. But every country that is worth its salt has tried to repatriate its gold vaults vaulted in America back home, whether it's France, whether it's London, whether it's Germany, whoever. And what is interesting now is that every central bank has basically kept part of their reserve in gold. That was not very topical until when we had the first of the major problems in the financial industry sometime during Obama's administration. But the London situation helped the world by saying, okay, the paper money of fiat currency is in trouble. Gold, this can step in. And if you then monitor the price of gold has come from circa 800, 1,000, climbed to 2,000, climbed to 4,000. And sometime early this year, when it was obvious that America was going to take very untoward policies in the Middle East, of course, everybody panicked and the price of gold went as high as 5,000. Yes, there's been a lot of price correction, but I will tell you the price correction did not come because gold weakened. What happened was gold played its normal role, which it was supposed to play for three major economies of the world. I like the one he has highlighted, which is Turkey. Turkey basically had to defend the lira or its currency. And to be able to defend Turkish currency, they virtually sold off everything they had, most especially their US holdings, treasury, and more importantly, they also had to trade in a very large volume of gold stock. Of course, at that point in time, the total demand was finally met, hopefully, by a large supply from the central bank. But I can assure you that since then, Turkey is making every blessed effort, now that they survived, to buy back all their gold. And indeed, they've since come out with a very clear statement. They didn't sell their gold, they only basically loaned it out to be able to have currency. Now the cash position is back. They are, of course, taking back all their gold back into treasury. But what he has also said that while the world continues to use gold as a balance of trade, especially for central banks, the way of leveraging and managing their currency. Every other central bank has also benefited from the fact that if you kept 1,000 kg of gold, maybe $800 when you bought it. If the price of gold reaches 4,000 and you want to value, because you multiply 1,000 times whatever it is, and then you say to yourself, there's a little increase in your reserve. Nigeria itself has benefited from that, given that it's buying more gold and it's also revaluing the gold currency in its reserve. So it's a win-win situation for everyone. For those of us who have been careful enough to buy gold, whether in 1 gram or less than a gram, or perhaps 1 ounce or up to 1 kg or whatever, we would also notice that over the last 3, 4, 5 years, gold has super performed, coming from $60 on the average for 1 gram to in excess of $90, $100 at peak. And more important is the fact that every day it's showing that it has reached a mark that we can call the minimum margin. The probability that we'll still get up to 6,000 this year is near certainty. Don't quote me, but I can.
Please, if you have questions, please drop it on the chat box. I'll attend to all.
Okay, thanks. So it's clear. Physical gold will surely be up there in whatever it is that we're doing. And because physical gold will be up there in whatever is happening, we will urge you, please, look at the current price of gold as a joyful way to enter gold now. And the reason is simple. When they finish the war in the Middle East, and it's not like when, it's if they would ever finish the war in the Middle East, the price of building new salination plants, the price of basically cleaning up the oil field in the Gulf, the price of making the bar beach or the many artificial lakes and beach in the Middle East, especially around Dubai and the rest of them, will cost a fortune. And to pay for it, certainly the price of oil will remain elevated. If the price of oil gets elevated, certainly inflation may creep in, and the value of the currency called dollar will be finally challenged. Why? If they raise interest rates, they are currently basically leveraged, not even over leveraged, whether it's over or under, they are leveraged. And they cannot afford to increase their interest payment to China, Japan, who are traditionally the largest set of investors. China, Japan have noticed that they may not be able to keep up with paying interest rates on their bills, and therefore they themselves are cutting back from investing in their so-called treasury bills. So America basically today is printing its own money and investing its own money. What that means, if it was a third world country, is a step in for IMF, a step in for World Bank, and they would basically say to value your currency. But fortunately for us, the dollar is always the dollar. And as far as the dollar is concerned, what you're trying to buy is a dollar, so therefore spend it in the US. And you can take it. And if you cannot take it from the US, exchange it at any rate, which is like. But we think that the dollar will be under pressure. And if the dollar is under pressure, the only person that can basically save you from that pressure will be gold. Therefore, all banks, every advisor that we listen to, have said to us, hopefully the price of gold will still remain firm. And only one thing is bound to happen before the end of the year. It will go up. Everybody's looking towards the month of October, November, and December especially. And everybody knows now that the whole of Europe is practically trying to go on holiday June, July, August. And once the traders come back, certainly they're going to head in only one direction, buy more gold. So before the big boys come in, any one of us who is a kobo buyer, to please try and get into gold as quickly as possible, and then overage your price out and watch it basically farmer. But the more important one is, what does the price look like in 5 years time? And that's what I concentrate all my energy on. In 5 years time, it's obvious that the price of gold will be totally elevated. Quite a few people believe it will cross the $10,000 mark. I am one of them right now, given the facts that you know. But what is the good joy and news that we have? Again, we have found gold within our exploration license area. We're doing everything possible to begin production. The terminals have arrived. We are finalizing on some of the tools equipment which has to complement it. The staffing is being, of course, trained to be able to mine professionally and, of course, return to you your coins and your bars. We are also working on trying to do streaming contract directly with you under the gold back token arrangement. And again, we would inform you via private mails the ability to be able to pre-purchase some of the products that we will be coming into our hands from our refining process. So on behalf of all of us from Dukia Gold, we would like to say, my joy by the grace of God is, yes, what we were praying for will really come to pass. I'll be able to say to you, come and see what the Lord has done. The second and most important announcement I need to make for you is that finally we have brought on board RESPEC, which is one of the best geological survey consulting practice in the world, to further assist us with our documentation, classification of our estimates and resources. Again, by this time next month, we have good news also for you regarding additional efforts that we're taking in further announcing thorough results, better results, and clearer documentation for resource and reserve of any metal that we claim we have, whether it's gold and or lithium or rare earth or every other ore that we are coming across. Again, on behalf of all of us from Dukia Gold, I want to say a very, very big thank you to Emmanuel, and also say a very big thank you to Paul and Joseph. I will yield the microphone now for questions. Thank you. Over to you.
Okay, thank you very much, sir, for this closing analysis. If you have questions, I'll drop a link to our FAQ. Please just write it in the chat and I'll attend to it. Just to conserve time, because of this is a Zoom presentation and I cannot answer all questions in depth, I mostly prefer you either call or send a mail to give you far further explanations. But I'm just going to answer tips and tips concerning the presentations and concerning our platform. So please, if I can't answer your question in depth, I'll also advise you contact me personally, then I'll definitely give you far further exegesis to your questions. Mr. Babatunde Oladide, we already have an app. It's on Apple App Store or Google Play Store. There you can actually download the site. But first things first, let me just drop the FAQ on the chat so that people can have access to that information. Give me a second.
Just to help anybody who is having issues with what you refer to as a dashboard, we shouldn't have issues with a dashboard. What you buy from us and what we keep for you, physical metals, whether it's 1 gram or less than a gram. Of course, the price of that metal will go up and down. In case there are some boards that are set at sell price. There are some boards that are set at the purchase price, acquisition price. Again, all boards, whatever version you have, whether it's version 1 or 2, must have the accurate metal that you have in your possession. It's not our business to advise you on how much you will sell your gold. So I apologize. Quite a few people set their metal price at purchase and sale price. But forget about that issue of valuation. What is most important for you all is that your metal is of a particular quantity, and that is audited in 3 regards. Before you buy, you check that that's the quantity you want to buy. So if you put in 51,000 and it bought you, for instance, 1 gram of the day you bought it, always check that you have your 1 gram, because that's the most important contract you have with us. If you keep that 1 gram from last 3 years, for instance, and you look at it today, 1 gram will probably be in the region of maybe 200 and something thousand plus. So most people who bought when we started have moved from circa 50, 60,000 to 200,000. Because a few people went as high as 300,000 when it was about 5,000 sometime before the war. Because the price had come back again to about 4,000, which is around 200 and something thousand. We don't need to tell you what the price at sale is. What we need, and we will always inform you, is the quantity of metal you have in your account. So again, please, we are very fastidious to metal in our custody, because that's what's important. And on the day you choose to sell, the price is of course known and advised. You see it missing, that's what you can pick up. We're grateful that all the assets under management of dogs is intact. We are also very happy to report that everyone who has attempted to liquidate or sell because of whatever reason has been satisfied return they have made and way in which we have handled them. So I apologize once again for anyone who is still getting a mixed dashboard. The dashboard should have amount applied to make a purchase, total metal that it has. If you want to sell, there is a sell dashboard which should be in front of you. And if you want to buy, there must be a buy dashboard which is in front of you. Confusing you with too many necessary information. Sometimes we've noticed while we were trying to be good to those who want to keep a daily reading, but what most people want to see is, what did I buy? How much is it? Therefore, we are very certain about what we're keeping. So any other question you have, Emmanuel, please deal with it. And any other complaint that you also have, please call us. We have a help desk. We have 3 people managing that help desk. There's a compliance officer, there's a sales officer, and then there's a sales director, and everyone around the table. I yield the microphone to you.
Okay, thank you very much, sir. The link to our support channels are on the chat, and the website is on the chat. So if you have either customer-specific complaints, we can just send us a message and we'll advise you based on your investment decisions. Okay, you're finding it hard to do your KYC. The requirements for Mr. Onyekachi Michael, if I got that correctly, the requirements for KYC are a proof of address and a proof of identification. Those are just the main requirements. So if you're using either the mobile app or the website, once you've done your BVN verification, the form will automatically show and ask you to complete your KYC. You just fill in the form with the correct details, upload your proof of address and your proof of identity, and your KYC is done within 3 working days, as verified by our compliance team. That's how it works.
If you still have a challenge and you need a help desk, please, there's a telephone number that will be put on screen, or to keep your privacy, you can send an email with your phone number, and we will immediately call you to walk you. We will always create a help desk for everyone who needs help desk. But it's important that we have your KYC. SCUML, AML demands of it, EFCC demands us to do that. Everybody in the banking industry knows that we cannot deal with a post-no debit person. You cannot also deal with anyone who has what they call EB exposure. Please send an email to us, give us your phone number, somebody will reach you and talk to you. We apologize if you have any glitch, but for 99% of the people, it's easy. For that 1% that also cannot do it, we're always here to ensure that we push you, hold your hand, carry you through. So please send an email today. Mayowa will call you. That's the person who will call you, and hopefully you'll solve that immediately. Mayowa, thank you.
Okay. Mr. Abdulatif Ibrahim. Okay, we have to. I'm trying to get a question. We have two options for purchasing gold, either the discrete gold or the pool allocated, and you are both permitted to buy both of them. So I'm trying to understand if you're saying you want to buy either of which, but you are permitted to purchase either the discrete or the pool allocated based on your investment decisions. So there is no restriction to purchase any of them from our end. I hope that clarifies your.
No, what I'll do to assist everyone is anybody can buy gold, provided you are a natural person, either known to law or the limited liability company, cooperative, or a licensed partnership. You can also buy gold as an individual or as a couple, or buy gold for and on behalf of a mine. Every gold you buy is a deliverable gold, provided, of course, that it's large enough to be delivered. So, for instance, someone says, I'm buying 5,000 naira worth of gold. That's about 0.0018 grams of gold, or 0.00018 kilogram. That is very nice to own, but difficult because they spec. So for that person, you would keep your gold with someone else who has bought maybe 0.001 until maybe it becomes 1 gram. So you are buying out of maybe a crate of Coke, or you are buying maybe just 1 cup, or you are buying maybe half a cup. And that's how pool allocated is. But it's physical gold, only that you are holding it in association with other people who are also buying tiny bottles. But if you are good enough to buy 1 physical deliverable, the least physically deliverable gold is 1 gram. And that physically deliverable gold that is 1 gram, honestly, it's available for you to pay for once or save up to by buying 5,000 until you say, okay, I've received enough, I've paid enough money, I've received enough tiny gold to make up to 1 gram. And then you can say, okay, now I have 1 gram. That 1 gram is a physically deliverable gold also. It's not pool allocated anymore. Therefore, the challenge that everybody has is, when would I be able to save up to buy 1 gram? Or when would I be able to save up to buy 1 ounce? Or when would I be able to save up to buy 1 kilo? Because people will say, if I keep the money, I will spend it. People would also say, if I don't buy now, I may forget. We have encouraged you to basically either buy at when you remember, which is buy on impulse, or buy by setting up what is called a standing order. And you can actually have a standing order of amount or standing order of quantity of gold that you want to buy. You then save up that gold in your vault, and basically you can look at it and say, okay, today I bought half a gram. Yesterday I bought 1/4 of a gram. Today I'm buying another 1/4. Therefore, I've made up 1 gram. Either way you want to go, it's going to be full, because at that time you have not yet made up a discrete. If you choose to convert from that discrete to physical, which is discrete ownership, it's just 1 tiny bar, or is one tiny ounce, or is one tiny kilogram. Either way, it's physical. You can feel it. So buy gold, whatever time and whatever value of money you have, build up your stock. Your stock will reflect as you build on it. There's what they call the averaging price of gold, which is if you buy every day, it makes more sense to me because then you gain the advantage, especially if you are saving up towards your child's wedding, or you are saving up towards your retirement, or you are saving up on a daily basis. We know people who usually put a job of 5,000 every day, and we also know people who are putting a job of 250,000 every month from their salary. People do 1 million. Whatever it is that you want to do, buy allocated gold, buy full allocated gold. It's still physically deliverable to you when it is a discrete and it can be discretely delivered. But of course, like I said, if you're buying 0.001 gram of an ounce, it's stock. Therefore, it's not really available easily to say I can cut that when I bring it to you. It's a dust. It take a long time for you to get it. But if you insist, of course, we will try. It's just that the cost of delivery to you means we have to file 0.001 gram of gold and put it in a little paper bag. Try and bring it. It can be done. If you need further clearance on how that can be done, it's a private call. Please call Mayowa and or Emmanuel and or Tonya or whoever it is that can handle that. I'm sure that that's done. For someone who sent a mail saying he buys to sell gold, we welcome you, but there are very strict conditions before we buy gold from anyone. We don't buy gold that is not LBMA, OECD, Minimata Convention. So if you want to sell gold to us, you must have the full documentation for the gold that is in your hand. We say it as follows. We've seen in a short span where people bring gold from under the bridge in Oshodi. They will claim it's their mother that suddenly died and left a lot of gold for them. When you ask them for how that mother left the gold, they don't have a will, neither do they have a testament, neither do they have anything. So we don't buy that kind of gold. We've also seen people who say, I have 10 kg of gold, and we say to them, where's your mining contract, and where is your mining license, and where is your production schedule, where is the state mining license authorization for you to come in possession of that gold. They don't have it. Sorry, we cannot touch that gold. But if your gold is legitimate, you have all the full documentation, send us an email, look at it, and we'll be able to, of course, advise you how to trade with us. We encourage streamers, and we too would also encourage you to come, but we just don't need jack ourselves into buying gold from just about anybody. We tried that in the past. We've known that Nigeria is quite interesting. People themselves by having fictitious gold function to try to prevent that gold. So there are many issues around buying gold that is not documented. So if you wish to supply gold to us, we have a very clean channel for that. But register your KYC, get your AML and everything. Let us have your full documentation, including your licenses and every paper that you need to send to us, and then we can have a conversation. The last matter I need to just quickly bring up again is the fact that gold will increase in value. Please protect your long-term wealth. Even if it doesn't increase in value and it stays at the price, or God forbid, reduces the price, trust me that that reduction in price will still reflect that you are in a better position if you are than if you had kept your money in stock and or in currency. We're not saying put 100% of your money in gold. Law, the advice everybody who's talking about this says put between 5 to 25%. But again, talk to your financial advisor who knows the condition and state in which your portfolio is at, and they will be able to give you the right advice. Over to you, Emmanuel. I think we can close so that we don't run foul of time.
Okay, thank you very much, sir. All right, if you have further personalized, if you need a personal guide to assist you through the process of registering or buying or you need far more clarification than we'll give on a public call, you can either contact us via our email line, which is clearly written on the chat, or you can still go to our FAQs. We've documented most of the common questions we get concerning delivery, KYC, platform authentication, BVN verification, delivery processes, every single thing that you can think of, we documented it in our FAQ. So we also suggest people to actually read it and get further clarification. But we will still be available to actually assist you, either via a phone call or a text message, to assist you on the whole site. But in essence, thank you so much for spending your time with us this lovely afternoon, the 30th of July. And we will be your trusted advisors in navigating the gold ecosystem. In essence, we've shown you why you need to buy gold. Chairman has also elaborated and reiterated that point, that the financial ecosystems will be fluctuating. And for you as an investor, the best moment to protect your investment decision is using gold. So in that regard, I'll call on the managing director to give us the closing remarks. I'll still drop the information again in the chat while we wrap this up. MD man, you have the floor.
Thank you very much, Emmanuel. And thank you everyone for staying through the session. We hope that you have learned a lot and that you would take the required steps towards enriching your gold investments. And for people with questions, as Emmanuel has said, please get in touch with us and we'll definitely solve the issues as much as we can. And apologies to the people who also said they've had issues. That is not our intention and it is not our culture. So please get in touch with us and we will resolve them ASAP. Thank you, everyone. And we look forward to having you at the next session. And pending that time, if you have not registered with us, please do so on our website, which is www.dukiapreciousmetals.co, and get onboarded and start your gold investment journey. We also invite people to invest even in the company itself, in the mining business. If you're interested in this also, please send a mail to support@dukiapreciousmetals.co. We thank you for joining us and we look forward to having you at the next session. Please invite others as you come so that they can also take the benefits of gold investments. Thank you, everyone, and enjoy the rest of your day and the rest of the month. Happy New Month in advance. Thank you. God bless you all. Bye.
Right. Thank you, everyone. Thank you very much, Mark, for that closing remark. Chairman, sir, you're on mute.
It's just to say thank you to everyone. Thank Paul. Paul, let you say bye-bye to everyone and let it go. Thank you.
We'll call us. Yeah, please follow us on social media. Social media handles are in the chat. If you have a message, please contact us. Thank you very much for coming. To have a blessed week. Thank you.